G'day, Greg.
G'day, Woody. How are you, mate?
Yeah, good. I feel like it's been a couple of weeks since we last got on camera for the Insider, but I thought it's about time we did. And the reason why I wanted to is because I thought you could just go over some of the things you've been talking about this week. Now, on Monday, you visited the idea of the battle going on between inflation and deflation. You said that the natural tendency of the global financial system is towards deflation and disinflation. So I thought it would be good for you to just explain what you meant by that and expand.
Yeah, sure, mate. It's funny when I often see these articles, inflation versus deflation, I just, eyes glaze over and I sort of tend to nod off. So apologies if that was the, view that someone might have got from reading the first bit, but it's really important because at the moment, and I wanted to sort of, I guess, talk about this from a financial market perspective and investment perspective, not just from a macro big picture. So when we talk about inflation, deflation, what I was sort of referencing is the fact that at the moment we're in a reflationary period. So all this stimulus money, the QE from central banks, fiscal stimulus from governments around the world, where money is directly being deposited into people's bank accounts as effectively enlarged unemployment checks. That has created a huge amount of stimulus in the global economy, and you're seeing that in financial markets, liquidity pushing prices up. And over the past few months, there's been a resurgence in this discussion about the inflation trade or the coming inflation, and whether it's commodities or whether it's stocks or just shorting bonds, how to take advantage of this inflation trade. So the reason I wrote that Insider was a couple of weeks prior to that. Who I consider one of the world's best monetary economists, a guy called Lacy Hunt from Hoisington Asset Management out of the US, who has been a long-term investor in US treasuries, and I'm talking 20, 30 years, and has ridden that bull market, which is probably rivals the bull market in equities, has ridden that to perfection. And he hasn't been shaken out of that view for a long, long time. And he's been writing a quarterly outlook and update for many, many years. And it's one of the best, economic newsletters that I read. It's funny enough, I tweeted it out a couple of weeks ago, or maybe last week, and I got one like from it. So it shows where people's minds are at the moment. They're not really willing to get into the nitty gritty of trying to understand how this system works. It's just like markets going up, inflation trade, sweet. We'll jump on board and make some money, which is fine. While the going's good, I definitely think you should be invested and taking advantage of that. The reason why I wrote the article, though, is I think it's definitely worth having one eye on the reality of the situation. And the reality is, as you pointed out, that the financial system is weighed down by debt. And that only got worse after the pandemic and all the additional debt-driven stimulus that governments injected into the system. In the very short term, that creates the impression that inflation is gaining the upper hand, because it's effectively like, the defibrillator on the patient's body. It sends this injection of life through, and you get this pulse, and everything looks good for a short amount of time. And in the context of the global economy, that could be 12 months, that could be 18 months, depending on the size of the stimulus and how long it goes on for. That could be even longer. But eventually, when that stimulus runs out, the global economy will resort to a disinflation or a deflationary position. And as Lacy Hunt pointed out in this article, all the academic literature and all the studies of real world economies say that the larger the debt pile gets, the lower the economic growth that is possible from an economy. So it's really saying to readers, hey, this inflation trade's great, but don't expect it to morph into sustainable inflation. There will be a point where the deflation trade comes back again. You need to look at your portfolio or positioning your portfolio for a potential deflation trade. And it's just to raise awareness. I always like to take the other side of the the trade, I guess, and say to people, look, this is priced into the market. What's not priced in, and therefore, where might you look to take a position and reallocate some capital for when this eventually happens? I've got no idea when it will happen. As I said, it might be 3 months, it might be 6 months, or might be even longer before this deflationary forces come and kick back in. But it's definitely something to keep an eye on.
But I guess that's our purpose really, is to give that other side of the story, because you're not going to really hear about that in the Financial Review or any of those places. But one thing you say, you described it as a reflationary recovery. But can I ask, how is it possible to tell the difference between a reflationary recovery and a real recovery? Because they probably look the same.
Yeah, and I think they do in many ways. But let's just look at something simple like the 10-year treasury yield, and we know that's got a lot of publicity over the past few months. This time last year, or maybe August last year, I think US 10-year treasury yields hit nearly all-time lows around 50 basis points. Towards the second half of last year, they moved up to around 1%. And then at the start of this year, or in February, March, they really jumped up to around 1.7, 1.8%, I think, around their highs. So we had a big surge in treasury yields, which suggests there's a bit of a recovery going on. But if you look back the past 5 or 10 years, that is still a very low 10-year treasury yield. And it's not really saying that the recovery is all that strong. So I guess it's a reflection of the increased amount of debt weighing down on the pace and the speed of the recovery. So yes, there's a recovery. Yes, there's a lot of money flowing through the system. There's a lot of liquidity pushing asset prices up. But when you look at 10-year bond yields, they are still historically very, very low. And if we were genuinely in a recovery that could sustain higher rates, then that would be happening. I mean, the reality is central banks are keeping, especially in Australia, the Reserve Bank is keeping interest rates held very low, so banks can lend and lend for property purposes, obviously, and that's why the property market's booming. But if there was a genuine recovery, the market should be able to sustain higher interest rates, and it's not able to do that.
Funnily enough, I was just talking with my wife this morning, and there's parts of Victoria now where it's just cheaper to have a mortgage than to rent. It's never been like that in Australia, really, I don't think. I remember it was always like that in the UK, but they're a bit ahead of us on the disinflation road.
Yeah, exactly. And that's another point to this, right? Like Australia, for many years, had a better national balance sheet than the rest of the world, and we still do, but it's not as good as it used to be. And certainly on the private side of the debt equation, the household sector has got probably world beating debt, and we're higher than many other nations, and amongst the highest in the world. So when you combine the private sector balance sheet with the public sector balance sheet, Australia's got very high debt levels. So we are in effect joining the rest of the world in this zero interest rate environment, perpetual QE, all that sort of stuff, which just reiterates the point that we've made across many of our publications. The financial system is pretty much broken, and it's the only way it can be sustained is with additional stimulus, and whether that's fiscal stimulus, monetary stimulus. You're seeing central banks come out with their digital currency platforms now. So all these things are going to play their part in the next 6 to 12 months to 2 years or whatever. But in the meantime, we're going to go through these periods of inflation, deflation. And I guess the message was you need to make sure that your portfolio has a little bit of inflation opportunity and a little bit of deflation protection in there as well.
You also mentioned on Monday, you mentioned just now digital currencies, and we've been talking about a lot about that in our editorial meetings each week.
Yep.
And how there's a kind of decentralized movement happening adjacent to the centralized movement, which is obviously led by the US dollar. But you also said on Monday, you warned against being overly bearish on the US dollar as well. Could you explain that?
Yeah, I mean, that's really to do with the fact that the US dollar, everyone sort of looks at that as the proxy for fiat currency. But you've also, it's really, the US dollar is really versus the yen or versus the euro. And in that piece, in Lacey Hunt's piece, he pointed out that the euro area and the Japanese economy are far more heavily indebted than the US economy. And he made this comparison. I don't have the stats just to hand, but he made this comparison of the relative size of the US economy to Europe and to Japan 20 years ago compared to now. And the US has outgrown Europe and Japan considerably over that period. And his contention is because of these debt differentials, it will continue to do so. So when everyone sort of says, central banks printing money, fiat currency, US dollar is going to collapse, I get the sentiment, but collapse against what? It's the US dollar is not going to collapse against the euro or the yen, because they are in as much, if not worse, economic trouble than the US dollar. The US dollar is also the world's reserve currency. So when you do get this return of this disinflationary or deflationary environment, and that might be triggered by a central bank all of a sudden getting a bit worried about, oh, maybe inflation is getting a little bit too hot. Let's start to communicate that we will be tightening monetary policy, that we will be putting the brakes on. Capital will just flow back into the US dollar, and the US dollar will then start to outperform. So, and then that will have flow-on effects with things like commodities and currencies like the Aussie dollar and stuff like that. So there's a lot of different moving parts you need to consider, and having that sort of textbook fiat currency equals US dollar collapse, I think you need to rethink that, because it's really the US dollar versus other fiat currencies as well. So if you don't like the US dollar, fine, buy gold, buy Bitcoin, other cryptos to get out of that system. But when it comes to fiat currencies, the US dollar is still the king fiat currency.
Now, on Wednesday's edition, you kind of carried on that discussion, and you almost concluded Monday's discussion in the roundup on Wednesday. And I guess you ended with that you figure the reflation recovery, when it starts to dissipate after a certain period of time, whether that's 12 months, 18 months, 5, or whatever it is, at some point, the powers that be are going to step in to try and reflate, because the debt load is just too high, and that's the only way they're going to keep things going. Now that presents a problem. It presents what do you actually do about it? Now, just from my interpretation, something to ask you. I mean, to me, it kind of makes things simple, but it also makes things extremely difficult. Now, the simple observation is that cash is probably a bad thing to be in. Interest rates going to be really, really low while asset prices going up. And you alluded to that when you said the richer are just going to get richer, and the people that aren't yet on that ladder are going to find it harder and harder to get on. But it also creates a difficulty in that there's immense amounts of risk in the market as well. But you've got to be in the market. What do you say to that? I mean,
well, I guess this is the problem that many people have, right? They understand that cash is just not going to do the job for them over the long term. So what I talk about to my subscribers is that, think about cash as having it as a tactical weighting. So you might, when you think that the market's very overstretched and there's a lot of enthusiasm for shares, and you're not finding much value in the market, maybe build up your cash to 10% of your portfolio and have that as a tactical weighting, and it's an option on giving you the optionality to buy into shares if the market does correct lower. So there is a place for cash, but not as a asset class. The asset class of cash that it used to be is going to lose you money over the long term. So you don't want to be sitting in cash long term. On the other side of the coin, the market, everyone's talking about this melt up, and the market's going to melt up. And I think in the future that is definitely there. But you alluded to it before. I think what happens is that eventually this deflationary forces will come back into the market. I don't think there's a lot of indication of that happening soon. That could be 3 to 6 months down the track. Right now, you're seeing a fair bit of heat in the market, but I don't think it's anything where you should be like, well, there's warning bells ringing everywhere. For the most part, the Aussie market isn't hugely overvalued from a broader perspective. But at some point, the deflationary hit will come back to the global economy, and I think that's when that will give central banks and governments the excuse and the ammunition to do something far more radical than they've ever done in the past. So whether that's central bank digital currencies, really experimenting with putting money directly into people's accounts, whether they're unemployed or not, whether it's a universal basic income, there's all these different things that could be done, but central banks aren't going to do it unless there's a emergency or mini emergency to do it. What they cannot do is let the system correct itself in the form of a recession or in the form of, creative destruction, because there is too much debt and it would threaten their power bases. Democracies like easy money. It's as simple as that, because once a certain group are under pressure financially, it puts pressure on the politicians, and the politicians are just going to go down the easy money route. I mean, in Australia, we've got a Liberal government that have modelled themselves for years on being economically responsible fiscal managers, and we've had the biggest fiscal blowout under their watch in forever. Now, people will say that was necessary because of the pandemic, but there's also the argument to say that there was a huge amount of waste in that fiscal stimulus that happened last year. So, how do investors deal with this environment? I think this is what I was sort of trying to get at in the essays. You need to have a diversified portfolio. You need to have gold and even bonds in order to deal with a deflationary environment. You need to have commodities and oil and last year I was recommending the banks because they were quite cheap, and they've had a great run since. So you need to be flexible, but also diversified in your approach to how you see the markets. Now, I've also got some gold stocks in my portfolio. They've had a pretty rough time over the past 8 months because they're more of a deflation hedge, not an inflation hedge. Unlike what most people are taught to think about gold. Gold works really well as a defensive asset in a deflationary market where there's tightening liquidity and all that sort of stuff. So the market will do this depending on how your portfolio is structured. But I guess what you don't want to be is 100% on a certain outcome when this outcome is potentially likely as well. And this is the reality that we're in at the moment, is that that there's no certainty about how this is going to play out. There will be periods of inflation, periods of deflation, and you need to have your portfolio diversified in order to protect yourself against either or outcome. Now, the other part to that is, if you've got a high weighting to an inflationary outcome, and then a deflationary period hits, do you stick with those stocks? How do you know when to get out? Should you cash up more? Should you divert more of your portfolio into a deflationary environment? And these are important questions, but a lot of the time we can't really answer those specifically, because obviously we're just we're giving general advice to thousands of different people, and everyone's got different circumstances. And there are tools that you can use, which I know that we're looking at trying to bring to our subscriber base to say, hey, look, we can't tell you this exactly. We can't show you how to do this, or can't tell you how to do this, but there are tools that you can use that will help you answer some of these questions. And I think, I wanted to, I guess, paint the picture of, here's the problem, but there are solutions to it as well. They're not perfect, and there's no perfect solution to a world of uncertainty, but there are ways that you can manage this situation better than probably what you've been able to do it now.
Yeah, and that's actually what we launched today specifically, was I guess it's showcasing one of these tools that would be a very good solution. And you're involved, Ryan Dintz is involved, and we've got a special guest that's going to be involved as well. But I think it would be a really interesting few days for people. And it's open today. So
yeah, look, and I just hope that that people find it useful, because I mean, it's something that I've used in the past, probably for the past 12 months. I find it really useful in helping me to allocate capital and helping to manage risk, all those sorts of things when you're looking at it from a broad portfolio level. And certainly for a lot of people that use a broad range of our services. And I know that we have small caps, large caps, trading services, and there can be lots of different stocks that come into a portfolio from all different angles and different perspectives. So trying to manage that when there's lots of different viewpoints that feed into building a portfolio can be a tricky thing. Who do you listen to? Who's got it right? So having a tool to overlay all that, I think, can be quite useful.
And overlaid all that is the market.
Yeah, well, that's that's another thing altogether as well.
Yeah. Well, we're going to carry on this conversation over the next week, and we just hope that people join in with us and get in on it.
Yeah, absolutely.
Cool. Thanks, Greg. That's awesome, mate. I think that's a nice 20-minute conversation.
No worries. All right. Good chatting, Woody, and take care. And we'll see. As I said, I don't think there's any real sort of signs that we're going to get this deflationary hit anytime soon. Although in saying that, I have seen the gold stocks start to tick up the last couple of weeks, which is always interesting, given that, when the market's very bullish and there's a lot of liquidity, people tend to get out of gold because it's a defensive asset. So the fact that there's money coming back in there and there's been a little bit of volatility come in. I noticed Pete Backer's algo indicators, oscillating between cash and going back into the market. So there's a bit of uncertainty coming back in. So it's worth keeping an eye on.
I actually wrote about that last Friday. It was all in the market for a good number of weeks, and then this week it went back into cash, and now it's gone back tentatively into the market. So I think it's 40% market, 60% bonds, and the fact that it is oscillating is telling you something, that there is shifts in the market. But yeah, so there we go. It's how you make it. That's the key.
Well, exactly.
All right, Greg, we'll leave it there. Have a great weekend, mate, and we'll more of the same next week. Thank you.
No worries. Thanks, guys.